it's likely once sites are fully mobilised that we'll see like a bottleneck of development loans which are coming to the end of their term. What are you doing now as brokers to try and kind of mitigate that bottleneck, and especially if there are fewer kind of lending options, funding options available?
I think you know, the first 2 weeks of the kind of the coronavirus shock that hit the market, one of our kind of biggest jobs has been working with our clients and the loans that we put in place, historic loans we put in place, and arranging conference calls, video calls, up in communication, having dialogue between the two parties, the borrower and the lender, and working really on a strategy that works for both on at the moment, a kind of best guess assumption. And I've got to say, you know, every lender that we've had these discussions with, or chaired discussions with, have been really forthcoming. I think it's been quite satisfying to see the way that lender and borrower have been working together. I think it's clear this is an issue that hasn't arisen because someone hasn't done their job properly. It's from, you know, a worldwide disaster that no one really saw coming, and because of that, the willingness to help and adjust where required to ensure people can fulfil their tasks has been really accommodating.
Yeah, I think Ed's covered it pretty well there. You know, we're not dissimilar to lenders at this point, where a lot of lenders are reviewing their loan books. We're reviewing our client books to ensure that the developments that we've put in place are there or thereabouts on track, or if there is a delay, how can we manage it? Is there a shortage of funding? If there is, how are we going to cover it when the market returns? Is there a case of having those conversations now? I mean, yesterday I was talking to a client who's drawn quite a big loan recently, and he was saying there's going to be a gap of a couple of million. How are we going to fill that? You know, so I guess to answer your question, it's all about being proactive and experienced enough to be able to foresee where the problems may or may not arise, and having those conversations and understanding, you know, is it a cash flow position? Is it, you know, a case of the goods not coming on time? Is it going to be a delay? Is it a time to pick the phone up to the lender at this point? So it's more about preemption, review, and understanding what clients want, managing that expectation and allowing them to have solutions. You know, in our business, it's okay to spot a problem and it's okay to have a conversation, but the most important thing is to have a solution. And I guess that's what Ed and I and the team are doing at the moment, is to you know, reviewing the client book, looking for the potential issues and finding the solutions that hopefully come with that.
I'm sure the next question is going to be something which lenders want to know the answer to. Michael, once a site is fully mobilised, if a lender asks for a new valuation, how would a valuer assess the project if they are in unknown territory?
I think that's a very challenging question, because we are in uncertain times. You know, that valuation, as we know, is it's an art, not a science, and effectively, from the development side, these are primarily driven by residual valuation, and residual valuations run by the GDV less the cost, allowance for risk, etc. Currently, assessing a GDV is quite difficult, in that, you know, transaction levels are down. Although, having said that, within London, Savills new development team, we've got probably about 475 live transactions, off-plan sales. They've only lost 12 currently, which is quite an amazing statistic. So that gives a degree of confidence to the valuation process. you also have to take into account when these projects are going to be delivered, and something that is at PC today is likely to be greater, or the impact will be greater than something that's going to reach PC in 2 or 3 years' time. The valuer isn't judging or preempting any fall in the market. And if I mentioned earlier on, if you've got a 5-year scheme, our forecast is sort of saying the market will be 15% higher over that period. So would you necessarily be impacting a GDV at that timescale? If you had a scheme that was PCing today, then yes, you've got to look at historic evidence, most of which will be pre-COVID, and then you have to sort of stand back and make a judgment and look at sentiment. So it could be that there would be a small current deduction in GDV value, possibly 5-10%. But in reality, most schemes at the moment are not being hit on the GDV from a valuation perspective, because valuations tend to be looking backwards as opposed to looking forwards. What's important to advise clients, particularly the banks and the lenders, is the wording around those reports. And currently we are in uncertain times. Transactional volumes are probably going to be down anything between 25 up to probably 45%, and that will have an impact. But what we probably don't see is a significant fall in value at the current time, because transactions are still happening. And if you look at second-hand housing stock, we probably had a mixed bag there. Some deals have just fallen apart. Others have put them on hold. But where there have been price renegotiations, those have been relatively minor, and you could call them insignificant in the scale of the transaction. So it's quite difficult. But fundamentally, you go back to the GDV, which we would assess, and then within the residual, we would be pushing out the cash flow to reflect delays in the supply chain and possibly delays in sales. But again, it would depend when PC is actually occurring.
Can I just add one thing? Actually, it's a question. Don't you think the price action is going to be a laggard in a certain way, and so it's in a certain way deceiving to look at price action now, but we'll have to see it in 6 to 12 months' time to actually judge what the impact is on GDV?
I would totally agree with that, but the difficulty is we don't have the benefit of waiting 12 months. If we have to put a number on something today, you have to make an assessment and form an opinion. Evaluation is an opinion at the end of the day. I think what you have to sort of perhaps do is say, okay, well, what was it worth pre-COVID? So you have a straight line in the sand, and then you can look at all sorts of different sensitivities. We can get cost inflation, supplier delays in the marketing, pushing back the cash flow. But as Dan said earlier on, you've also got to reflect the fact that perhaps they're not spending millions or tens of millions of pounds a month because the site's on hold. So it's complicated, and you have to look at all these things. So, but I do think having a valuation pre-COVID gives you a line in the sand from which you can then make an assessment, and Dan and other lenders can look at their lending criteria based on something that was relatively solid, and then you can play with sensitivities.
Out of interest, Nicola, how will this impact you putting together business plans, costings, when for future projects, if the GDVs are unclear, as Michael said?
Well, I think I'm still very far away from putting business plans together, for the simple reason that every time I do an assessment of a land value that I want to buy, my value is about 50% of what actually the sellers want to sell it at. So I think before we come to an agreement on those terms, I think several months will come by. On the other hand, we have a different strategy in place at the moment where we've raised capital for bulk buying in the distressed market of new home sales. So we're kind of a gamekeeper turned poacher in a certain way. And what we can see is that pre-COVID, there weren't that many developers that wanted to chat with us for substantial discounts on substantial bulk sales. All of a sudden, they're coming out of the woodworks in the last 2 weeks. So that intimates to me that actually people that were, this is also not just in the high end, this is also at the 500 to 1,000 pounds a foot. They're starting to be much more pragmatic. They realize that sales are going to be much slower than they expected, and that they're entertaining bulk sales at significant discounts that they were not doing before. That's why I'm bearish on the price action in the next 12 months, because if that starts happening and those transactions start printing, it will create a different expectation for buyers in general in the market.
And Michael, just to add, with some lenders have come out and said that they won't lend if a valuer has put the kind of material uncertainty clause into their valuations at the moment. What impact will this have on the market? Because how long will valuers be putting that clause into their reports?
Well, I think the material uncertainty clause is always a hot topic, and this time round is no different. The way this sort of arises is that the major firms sort of get together in association with the RICS, and it's agreed across the industry that the clause would be utilised. When will we stop using that? COVID will have to have been, well and truly sorted out, one would imagine, and uncertainty would need to be taken away from the market. We found that some lenders will not lend at all if that clause is in evaluation, but many will. And I think it's a case of understanding what it's there for, and it goes back to the scenario of valuing a development, whereby you can say, okay, well, let's start with the position of assuming COVID hasn't happened, draw a line in the sand, and then making allowances going forward, reflecting what evidence is available and what sentiment is currently in the market. We talk to our agents all the time. So that's a challenge. But I don't know, Dan, what's your policy on the you see one of our valuation reports, and do you instantly move the LTV by 10% or 50 bips? What do you do?
Well, we normally arbitrate a debate between you and the borrower, Michael, as you know. I think on the valuation point, I mean, you make a point on some lenders won't proceed if there's a COVID-19 clause on there, and I think that being a bit controversial here, I think if a lender, maybe a construction lender or a higher leverage lender, if they are lending entirely based on a red book valuation, then that's probably not a sensible underwriting basis for them to be lending off. These are used as guides to assist with the assessment of risk, and if a lender is experienced and here for the long term, then they'll use that valuation to understand the risk, ratify the business plans of the developer and the borrower, and use it as a tool for pricing. But that shouldn't be the sole decision for lending, in my view. And I think that those lenders who come along without the necessary skills are potentially not great for the marketplace, because they can cause some problems, and I'm sure Ed and Matt will be able to comment on this in a second. But from a policy point of view, whether that clauses in there or not, you know, we'd be picking up the phone to you, Michael, and your team, and having a discussion and saying, you know, let's challenge some of the assumptions, let's talk about it, let's look at the comparable evidence, right? We understand it's difficult because you've got reduced comparable evidence. You can't be as certain as you can another time. So, but that's okay. You know, we can form a view, we can assess the risk, and then we can make the decision whether we lend or not.
Well, I think that's the most important factor, isn't it? Understanding and assessing the risk. And, you know, if you've got a base valuation, you can then look at all sorts of different sensitivities, whether it be that, you know, moving the construction cost, you know, pushing out the timing, etc. But, you know, giving you informed advice is probably the best we can do. You know, we don't, an evaluator cannot try and preempt the market going forward in a challenging environment.
Yeah, and I think that's right. And, you know, we know, looking back historically, what assets and geographies and types of property perform best and perform worst in such downturns, you know, and then we use that to shape our risk assessment, you know, and there are some very resilient subsectors of the residential market that perform well in downturns, and there are some that perform badly, and, you know, some will, as you know, some will be down 5%, some will be down 35%, and that comes back to the underwriting. And certainly from Fortwell's point of view, you know, we would unlikely lend against an asset class which could be so volatile to a downturn. It's probably not something that we pursue as a lending opportunity. We probably more gravitate towards those sort of subsectors that show a high level of resilience. And I think all I'd add on these general themes is, you know, that this is going back to what Nicola said. This is it's a bit of a pause hiatus, and it's very difficult to assess value. What we probably all sit here with some level of surety believe is that, you know, there will be a gravitation back to a more normal market. You know, people will need to sell, sites will need to be sold, equity will need to invest to make return for their equity investors, be it private individuals, be it pension funds. You know, so people will want to buy sites. There will be sellers because funds have redemptions. You know, house builders have a lot of stock. They will need to sell stock in order to manage their own position. So, you know, we will get back to a market which is normal. That might be 3 months, that might be 18 months. You know, that is the unknown thing. You know, just take a look at COVID-19. You know, COVID-20 might come along at the end of the year, and we're having this conversation and we know further forward. But assuming it doesn't, you know, we should have some belief that this will get back to some semblance of normality at some point in the future.
I certainly agree with the pause. But interestingly, and this is a bit of positivity, since the outbreak of COVID, our land team within London has sold, exchanged 9 sites at a value of about 146 million. So, you know, that there is some activity out there.
I have a quick question just from our readers as well, just to follow on from this, Michael, that there is a hardening professional indemnity insurance market at the moment for property surveyors. Quite a few surveyors were supposed to renew in March, but because the market is becoming a bit difficult to renew, what impact will this have if we have fewer surveyors in the space?
Means we can maintain and push up our valuation fees. On the insurance point, this isn't really my field, but currently premiums on insurance are not increasing as a result of COVID. I think if there are less surveyors in the market, then it probably will have an impact on the timing of some transactions. And, you know, I was joking a moment ago about valuation fees, but they will probably be pushed upwards. But I think they've been pretty hard done by over the last few years anyway. But I think it will just cause a delay, but in the scale of a standard property transaction, not a great deal of impact.